Aloha, I'm Carl Bonham, Executive Director at UHERO and Professor of Economics at the University of Hawaii. Welcome to the last UHERO Focus video for 2023. I'll be talking about our fourth quarter forecast, and the good news is that it's quite a bit more upbeat than the forecast we released right after the Maui wildfires. You might remember that in our third quarter video, we were talking about unemployment insurance claims on Maui and how much they had jumped right after the fires. And actually by mid-September, continuing claims for unemployment insurance benefits on Maui had increased to almost 9,000 people. And by the end of November, they'd fallen to roughly 5,000. So about 4,000 of those people who were getting benefits in September are no longer receiving benefits because they've either found work on Maui, maybe they're working on the recovery process with FEMA, doing hazmat type work or with the American Red Cross, or they just found work in the rest of the Maui economy because the labor market was so tight before the fire. All of those are very positive. An alternative explanation is they've left Maui and they found work somewhere else. Obviously that's not quite as positive, but while we've seen a sharp recovery in the labor market, we think it's going to get harder to see continuing gains going forward. And there's a long road ahead still. And so I want to focus on the overall state economy in this focus video and recognize the importance of how strong the US economy has been for Hawaii's economic health. It's beginning to look like, and there's beginning to develop a consensus that the Federal Reserve may have actually orchestrated a soft landing. And you see that primarily in the rapid decline in inflation. And we've achieved this decline in inflation with almost no increase in unemployment and no layoffs. And so while the different measures here, there's the headline CPI, which is the light blue, there's core in orange, and then there's what the Fed is really watching, which is services inflation measured by the super core. And the super core is almost is really at the Fed's target. And so with a little patience on all the measures of inflation that they track, we think that when they meet the week of, I think it's December 11th and 12th, they're meeting, so right before this video comes out, we don't think they'll raise rates then, and we think that actually by spring they'll start to lower rates, and that will help to maintain consumer spending. It'll help those interest-sensitive sectors of the US and Hawaii economy, particularly housing, home buying, home resales, and even home construction. And so why is that so important? Well, the resiliency of the US economy is underpinning the strength in the US visitor market. And right now, US visitors to Hawaii make up about 3/4 of all visitors and all visitor spending. And so keeping that stable in the wake of lost visitors to Maui is incredibly important to Hawaii's economic health. This chart shows you visitors to Maui in the gold line. It's actually the average daily census, the average number of visitors on island in any month. And the light blue line is visitors in the rest of the state. And leading up to the pandemic, all of 2019, and even into the beginnings of the pandemic down here, these two series tracked very neatly. These are index graphs, so we can see differential growth rates. And so you can see that as we exited the pandemic in the summer of 2021, Maui was really booming because of the US visitor. And then with the wildfires, we went from basically 100% of pre-pandemic level of daily census. We lost half of that. So Maui County in August and September, average daily census fell by about 50%. The good news is that we've seen a bounce back in October. We've gained back about 10 percentage points of that. So that's that sort of sharp recovery that we saw initially, and we expect that to slow as we go through 2024, and eventually we're going to start running up against constraints that come from the lack of housing. Until we add enough housing on Maui Island to house all the displaced residents and recovery workers, there's going to be some shortage of places for visitors to stay, which will then contribute to a slower economic recovery than I think we would like to see. Now, some of this focus on the U.S. market and the fact that the U.S. market dominates with about 3/4 of all visitors comes because the Japanese market hasn't recovered like we would like. As of October, Japanese visitors to the state are at about 45% of pre-pandemic levels. Our forecast last quarter was for them to reach about 50% in the fourth quarter. So we're not that far off. A lot of the focus in understanding why Japanese visitors have not come back has really looked at the depreciation of the yen. Right? So essentially, potential Japanese visitors suffer sticker shock when they look at a trip to Hawaii. They look at higher prices for hotels, higher prices for food and activities, and then they look at paying those higher prices with a yen that buys about 35% fewer dollars than it did before the pandemic. That would suggest that as the Fed starts to cut interest rates, we might see some improvement in the yen, and that could help. But it's not entirely a story about the weakening of their currency. If you look at Japanese outbound travel to other major markets for Japanese tourism, you'll see that South Korea, all the way over here in the first bar, has recovered to 100% of their September 2019 level of visitors. So this is September data. We're comparing September 2023 with September 2019. And South Korea is at about 100% of Japanese visitors to South Korea are at about 100% of their 2019 levels. To Australia and New Zealand, they're in the high 60s, low 70s. And actually, Australia, the yen has depreciated against the Australian dollar almost as much as it has against the US dollar. But the recovery of Hawaii versus the recovery of, say, South Korea, New Zealand, Australia, suggests that Japanese visitors are tending to travel closer to home right now. And so longer term, we don't have, if you go out to the end of the decade, our longer term forecast has Japanese visitors recovering to around 85% of pre-pandemic levels all the way out at the end of the decade. So let's talk about the broad state economy. And, you know, like the visitor industry and jobs on Maui, the broad economy measured in the gold bars here, this is real GDP growth rates for the state as a whole, are expected to be stronger than our last forecast. So after growing at almost 3.5% in 2023, we think overall output, that's what real GDP measures, will grow a little bit more slowly in 24 and then jump to almost 3% by 2025 as we start this recovery process and this rebuilding process on Maui. So the one area where there's significant room for concern is really in population, which has been declining since 2018, and that's the dark blue line here. And it's the one area where we've actually lowered our forecast versus the third quarter. And so overall, we're still looking at a relatively long, slow recovery for Maui. But very much like we said in our last forecast, the state as a whole is going to weather this with really just a sort of pause or slowdown in economic growth rather than any kind of a deeper downturn. So mahalo, and I wish you happy holidays, and I look forward to coming to you with a video in the first quarter of next year. Aloha.